Hello, it's Jordan, and this video is being recorded on the afternoon of Tuesday, April 5th, 2016. And here we have a picture of the S&P 500 and the 2008 crash and then its recovery from 2009 through 2011. And I mean, to answer the question in my title, I mean, when is the toughest time to buy? The toughest time to buy a market is when it's in a new bull market and like right after that time when it's had a V type recovery and it looks really overbought, sentiment looks really bullish. It looks like the market should correct and everybody recalls the previous bear market that was bad. But oftentimes what ends up happening is the market just continues to move higher. And I just want to talk about that in the context of what's going on the gold stocks right now and just give some historical examples. And this is a good example. I mean, the 2007 to 2009 bear market in equities was, I think, the worst bear market since you have to go back to the 1930s. I mean, obviously it wasn't that long. It only turned out to be about 18 months. But nevertheless, I mean, it was really deep as far as price. And as soon as the market got going in early March 2009, I just remember it just exploded, and there were still a lot of people who said, oh, well, the economy's terrible, the market's going to go back down, it's going to have a correction, this is just a big bear market rally. But what happened is the market just kept moving higher and higher. And if you look at this, the S&P had an 80% rebound in 14 months. And the biggest corrections during that time were 7% and 9%. And note how during that period the S&P held above the 50-day moving average almost the entire time. I mean, it did go below during those two mini corrections, but other than that, the 50-day moving average was a good indicator, and that's something you have to watch for in these types of situations. And then the market, even after the first 14 months, I mean, it had a 16% decline, but it kept moving higher into 2011. And ultimately, I think it was up 100% in the first 2 years. But most of those gains come early on. But even if you miss the first couple months, there's still time to get in and make a lot of money. And so this is one example. Another example is the NASDAQ after 2002. Again, terrible bear market. I mean, a real crash from 2000 to 2002. What happened with the NASDAQ after it bottomed in October 2002 was it almost doubled in 15 months, and it had the worst during that period was a 15% correction, and that was kind of at the beginning, the very beginning, when people weren't really sure if the bottom was in yet or not. And you see that happen a lot. And what I mean by that is when the market's bottoming and maybe it's coming out of a base. I mean, that's the point. That's a point where it could have a sizable pullback, like it did in this case. But 15% for the NASDAQ is really not that much. And again, after that period, the market really exploded, held above the 50-day moving average for most of the time. And then what happened after, from 2004 to 2006? Yeah, the market really didn't do much, but as the trend decelerated, but the market still continued higher. So that's something that happens after. A lot of times you get that big V move, and then the ascent or the acceleration just kind of flattens out. The market keeps trending higher, but not as sharp as it did off the bottom. And my last example of that is the gold stocks and what happened after the bear market during the financial crisis. And this is my own custom junior gold index. I think there's about 18 stocks in this index. And as we know, the bottom was October 2008, and this index is in US dollar terms. And I highlight the corrections, and you can see, I mean, they're somewhat sizable, but we're dealing with junior gold stocks, and this is an index that is even more volatile than GDXJ, for example. So if GDXJ only corrects 10%, I mean, this is an index that can correct 15%. So even though this had 15, 17, 20, 25, 26, those were not that huge of pullbacks in GDXJ. And you have to take that in the context of, I mean, this was a spectacular gain coming off the bottom in Q4 2008. If you can see, this index bottomed around 100. I mean, in early the following summer, it had a peak at 450. So we're talking about a 350% gain in 6, 7, 8 months after the bottom. I think the 1 year gain ended up being like 450% or something like that. And by the way, that's pretty similar to what happened after the 2000 2001 low with respect to my own custom index here. And look at the 50-day moving average, which I've bolded here. During the recovery period, the market held above the 50-day moving average basically almost the entire time, from the middle of December into June. So the 50-day moving average is a support that you need to watch. And so, I mean, these, even though these pullbacks, they look somewhat sizable in percentage terms, but they really weren't, because the index was having massive gains, and the index never really went below the 50-day moving average. So, I mean, even if someone they bought into this, let's say in January or even February, they still ended up making a lot of money in the months ahead. And another thing I want to point out, when you're in very strong markets, the corrections, they tend to happen very quickly. Um, if it's going to correct 15, 20%, whatever, those tend to happen very quickly. I mean, they can happen in a couple weeks, they can happen in a month, and then it's basically over. It keeps going higher. And when the market consolidates in a tight range, the pullbacks aren't that sizable. And that's kind of what we're seeing in the gold stocks right now. And I just want to talk about GDXJ before I end this video. And the miners have basically, I mean, this is the sixth week, I mean, depending on how you look at it, the sixth week of consolidation on the weekly chart for the miners, for GDX and GDXJ. And GDXJ has been stronger, and what you can see is it's just trading below 29, which is resistance. I mean, it's holding above initial support. I mean, it's holding above not even like the 38. We're not even talking about the 38% or the 50% retracement. It's holding way above those, and it's held above initial support. And even the 50-day moving average, which I talked about in my most recent editorial. I apologize for not having that chart up, but the miners have been holding well above the 50-day moving average. And you saw in those other charts how you can, in this type of situation, you can use the 50-day moving average as support. And so if you look at the daily chart of the miners, you can see they're still somewhat overbought and holding a little too far above the 50-day moving average. So I think that's why I think this consolidation could continue for a couple more weeks. We need the 50-day moving average to catch up. But I think if I'm going to be wrong on that, I'll be wrong, in that I'm not being bullish enough and the market breaks out. But anyway, we can see here, so GDXJ, very strong move, but now it's been consolidating for 6 weeks. It's holding above even initial support, so it's showing a lot of strength. The potential upside targets would be, if it breaks above 29, would be 33, and then it looks like 42. So, I mean, if the miners, I should say, consolidate for a couple more weeks, I mean, they could be building a bull flag here. And that last move was from what, about 12 to 28 or 29, so you're talking about 16, 17 points. So, I mean, it's possible that if this is a bull flag and the miners are, they have a big strong breakout here and they're going to make another strong move higher, I mean, it's possible that the next peak won't be at 33 but maybe at 42 there, at some point in the summer. And then that could be the time when you get the miners having a big pullback and perhaps a longer consolidation. But I show here a chart going back to 2011 just to show how much the miners in GDXJ in this respect have declined. I mean, this index, I forget where it peaked, but I mean, looking here, it was back near 140 2011, and it's only at 28 right now. So again, if you're looking at a daily chart, a 3 or 4 month chart, yeah, the miners look totally overbought, but again, they've consolidated for 5 or 6 weeks. I expect it to continue for another week or two. And when viewed in the context of they're just coming out of what was the worst bear market, the longest bear market, and worst bear market in terms of price in 90 plus years. I mean, considering that there's not a lot of sellers left. The people on the sidelines, they want to get in the market. So It's and again, this gets back to the title of my video. That's the toughest thing to do, is when the market's already gone up, it looks really overbought. The toughest thing to do is to buy into that market. But based on what I'm seeing here, I do think that the next big move for the miners is going to be higher, not lower. And so what do you do? I mean, how can you assure yourself you're going to get a decent entry and you're not buying something that is too overbought? Well, here's a couple things you can do. Identify the leading stocks and buy when they pull back or consolidate. And so when we're looking at individual juniors, what I've noticed, a lot of my favorites in the last couple weeks during this consolidation, they have not corrected much more than 15 or 20%. Now, if we were going to have a big correction, you'd probably see individual juniors, they'd be correcting 30, 35%. But their corrections are kind of, for most of them, are kind of maxing around 15 to 20%. So in that context, if you can buy something that's down 10 or 15%, that's a good entry point. I mean, it's only a bad entry point if that miner is going to go down 30 or 40%, which it doesn't look like it's going to happen right now. So try and buy weakness in that respect. That's a good entry point if you can buy something that's off 15%, because even if it goes down 20 or 25%, you're only losing 10% before it turns around. So that's really what you have to do. You have to buy things that are down, that have corrected, that are down 15 to 20%. And you also have to look at the fundamentals and see where the value is. I mean, there might be some stock. Look for the stocks that you really like. Maybe they've been consolidating. Maybe they didn't perform as well in the last month. Look for those that have potential to really lead during the next big move higher. And also, you have to prune your portfolio. You have to look at the stocks that you own, that they aren't acting as expected. Maybe something went wrong. Maybe there's a negative fundamental development. Maybe it's corrected a bit too much and buying and hasn't really come in yet. Then look at that and consider swapping that out for something you don't own. So all these things I'm mentioning here, these are things that I'm personally doing. Thank you so much for watching this video. And if you want to follow more of my work, go to thedailygold.com. You can get a free copy of my book at thedailygold.com/book. Thank you all for listening and watching, and I'll speak with you again soon.